So unfortunately, most of these policies are set up incorrectly in order for agents to get paid a higher commission at the expense of your financial goals. So today we're going to cover how to structure a policy correctly for tax-free retirement income, having those living benefits to protect you, and solid growth safe from any market loss. So what is an IUL? An IUL, or an Index Universal Life Policy, it's a form of permanent cash value life insurance that grows tax free. So, who might benefit from a cash value policy? Well, typically middle to high income earners who are looking to build some tax free retirement income, business owners who would rather be their own source of capital instead of relying on loans from the banks year after year, or even just homeowners, parents, or spouses who are looking to leave behind a guaranteed legacy and still be able to borrow from that cash value for investments, fixing up things on the house, whatever that may be. So, how does this work? Each month, a monthly premium goes in. In this example, it just shows 500. Each month that premium goes in, a portion of it is going to go into the cash value. That's what grows tax free year after year, and that's what we can actually borrow from. The other portion is going to go towards our death benefit or our cost of insurance. So, general rule, the more money that we're spending on the insurance coverage and the death benefit, the cost of insurance, the fees, the less money is actually going to be going into our cash value account, which is what's growing tax free and what we can actually borrow from for things like retirement or investments. So, how does this work? Under the IRS code, we want to make sure that the policy is a non-MEC. A MEC would be a modified endowment contract. All that means is that you haven't hit the minimum amount of life insurance coverage in order to keep things tax free. So when the policy is a non-MEC and we've met the minimum life insurance requirements, the policy is going to receive a favorable tax treatment. So that means that policy loans are not treated as taxable income when you take those loans out, and the gains within your cash value are not going to be taxed while the policy is in force here. So the basic principle behind how your money grows in the cash value is indexing. When compared to traditional market volatility, where we have big highs and big lows, indexing is going to be a lot more like a stair step. So year after year, the principal is protected. When the market goes up, the account is going to grow up to a certain cap, usually 10 to 12%. And when the market goes down, if it drops negative 20, we don't get a return that year. It's 0%, but we don't lose any money that year. So it's going to be steady. And every year, our principal is protected. We don't lose money from market volatility. Some red flags to look out for when speaking with advisors on IUL. Number one is going to be super high death benefit amount. If our coverage amount is really high, we have a lot of insurance, we should already start thinking, hey, we're probably paying too much money into the cost of insurance and not enough into the cash value where it's actually going to grow. Red flag number two is going to be several years with no surrender value. So we'll go over what this means in a minute here. But surrender value is basically what you can borrow from the policy in each given year. So if you look at an illustration and you have several years at the beginning of the policy where it says $0 surrender value, it means that you're probably not growing enough cash value and you're not going to be able to borrow from the policy for a really long time. Third red flag is going with a company that's not A or A plus rated. All of these insurance carriers are rated on their financial strength. That's going to be important because we want to have guarantees and security around not only just our growth, but also making sure that everything pays out clean and fast to our family when we do pass away. So A or A plus, making sure the financial strength is good, the company's been around for a long time, and they're reputable. Red flag number four is using random indexes with no proven track record. So typically, the best index to go with is going to be the S&P 500 on these policies because we have a good idea of how that's going to perform on average. Some of these companies, they'll create new indexes and they'll say, if this index existed for the last 20 years, you would have gotten an 8% return. And so now you should track your money along with that. I don't feel super comfortable with that. So I like to go with things that we know what to expect from for the most part. So just not leaving things up to chance, going with stuff that's tried and true. Fifth red flag is if the advisor you speak with isn't asking about your income, what tax bracket you're in, or your goals. This isn't something that just needs to be thrown at you. This should be fitting into your overall portfolio in order to get you to your goals as quickly as possible and as efficiently as possible. So, the correct policy should give us tax free growth in the cash value, should protect us from any losses and market downturns. It should allow us to have access to the cash value with no penalties, and it should leave a guaranteed legacy and build generational wealth if those are some of our goals. So now we're going to look at a couple different examples of the same client, the same policy with the same company, and just show how important it really is with how your policy is being structured. So in scenario one, this is going to be a policy that has been structured improperly for retirement income. And scenario two is going to be one that's actually been set up the right way. So in this example, the client is 35 years old, and is putting in $1,000 a month, 12,000 a year. A few things to look at. The accumulated value is going to be the cash value. That is what the insurance company is crediting interest on based off of that number year after year. Cash surrender value, like we talked about earlier, the surrender value is what you can actually borrow from the cash value in that given year. And then obviously the death benefit, that is the life insurance coverage. That's what pays out to our beneficiary tax free. So in scenario one, the client has put in $12,000 that year. After the cost of insurance and the fees, their cash value is only at about 6,864, and the amount that they can actually borrow in that year is actually $0. Third thing to look at is the coverage amount is super high. So that should be already giving us that red flag when we look at it right away. Compare that to scenario two, same exact client, same exact company, same exact product. But in this structure, out of that 12,000, we actually have 10,443 in our cash value. And the amount that we can borrow from is almost half of that in the first year. As we go down the line in year 10, we've now put in 120,000. And in the improperly structured policy, we haven't even gotten to what we've paid in. So we're only at about 75,000 in the cash value. Compare that to the other policy that's been set up the right way. Now we have 140,000 in the cash value tax free, and we have access to majority of that. The further we go down the line is really where you see the differences. So in year 20, when the client is 54 here, in the improperly structured policy, we only have about 200,000 in the cash value. And this is where the big difference is as we go down the line and time goes on. 200,000 compared to 426,000 in the cash value that's tax free, and we have access to all of that. Another thing to notice is in the policy that's been structured correctly for retirement income, you'll notice that obviously we start at a much lower death benefit amount, but each year it's slowly increasing bit by bit. Now, remember, the reason for this is that as our cash value is growing, and we already started off here with the minimum amount of life insurance required, in order to keep that growth tax-free year after year, we still need to stay at the minimum amount of insurance. So as the cash value is growing, the insurance coverage amount is going to have to grow a little bit to keep up and keep everything tax-free. So again, the correct policy should give us solid tax-free growth, should protect us from market losses in a downturn, should give us good access to our cash value with no penalties or restrictions, and it should allow us to leave a guaranteed legacy behind and build that generational wealth. So for us, we work with all of the top A-rated carriers in the nation. How do you make sure that your policy is set up correctly? You just book a call with myself or one of our trusted advisors to go over, most importantly, what are your goals so that this is structured to get you to where you actually need to go. The cash value structure, if you have an IUL or even if it's your first time, walking you through all the details and making sure that this is structured for the maximum amount of cash growth. And then explaining your questions that were never answered. A lot of times people get thrown into these policies, but they still have a lot of questions that haven't been answered, and you deserve to have those questions answered. So, again, in order to make sure that things are set up, whether you have an IUL now or this is the first time and you're planning to get one, you can go ahead and scroll down and book a call on the calendar at the bottom of this web page. One of our advisors will meet with you, and we're happy to hear about your goals. Thanks for watching.